Invest in real estate rental property somewhere in your life because it can allow for up to 4 main methods of exponentially increasing your total net worth. You can get ROIs up to 40% yearly. It's super easy to get started, and there will always be a need for land and houses to live in. So let's get started. Let's assume that you find a $100,000 house that you want to buy and you want to rent it out to your friends for a total of $900 per month. And that's actually pretty easy when you can get 3 of your friends to chip in $300 each. Plus, $100,000 houses in my area can easily support 3 people. Now, your real estate prices and your rental prices might vary depending on where you live, but these numbers are pretty average for houses in my area. Then you would need to go to the bank to get a loan because you probably don't have $100,000 cash. And technically, even if you did, it would not be smart to pay all cash. You want a loan to be able to leverage your money. Now, the bank says that they will loan you 80% if you can come up with the 20%, which is $20,000. Well, your grandmother passed away and left you $25,000, so you decide to buy the property and rent it out. So here's how the normal process works. You have a $100,000 mortgage. You put a $20,000 down payment on it. That leaves you with an 80% loan, which is around $80,000, at 6% interest for 30 years. Plus, you also have to pay around 3% closing cost, which 3% of $100,000 would be $3,000. You have to pay the bank, the government, stuff like inspections, and there's a few other people you gotta pay. So your total expenses, using these numbers, leaves us with around a $480 monthly payment to own the house. Now, in real estate, we'll also have around a 1% expense for taxes, and that would be around $1,000 for our example. You'd also have around a 1% expense for the maintenance, stuff like plumbing, electrical, maybe replacing the roof throughout the total of 30 years, and that's around 1% too, which is around $1,000 a year. And you also have around a 1% expense of insurance. Now, these numbers vary a lot depending on where you are, what kind of property you bought, and what you plan on doing with the house. But let's just say 1% plus 1% plus 1% equals around 3%. So to come up with your total yearly costs of renting this house, we multiply the mortgage payment by 12 to get us our yearly cost. And then we add in the other stuff that I mentioned. So $480 a month times 12 months is $5,760, and that's just to pay for the house. And then we take 3% of $100,000 because of all those little expenses that we talked about, and we get $3,000 per year just to be able to rent it out. So to buy the house and to be able to rent it out, we have a total yearly cost of $8,760. Now, let's say we're going to rent the house out for $900 per month. $900 a month times 12 months, and then we multiply that times 0.9, which is a 90% vacancy rate, which is pretty average, and you get $9,720 as your income per year. Now, to calculate our profit, we take our income minus our expenses, which would be $9,720 minus $8,760, and we're left with $960 profit that year, right into our pocket. Now, that doesn't really seem like much, does it? But when you take $960 profit and you divide it by your total amount invested, which is the $20,000 down payment and the $3,000 closing cost, you get an average of 4% cash-on-cash return, which is actually an okay ROI. This means every dollar that you put in, you get 4% out each year. Also, I want to let you know that rents can and usually do increase every year, and most rents increase at least every 10 years. But this isn't where wealth is created. This is just income. And there's a difference between wealth and income. For example, Jeff Bezos, one of the richest people on the planet, has an estimated net worth of $160 billion. But that does not mean he has $160 billion to spend. Most of his net worth is tied up in his shares and stocks of Amazon. So let's get on to the second form of net worth increase. This is principal paydown. Remember, at the end of those 30 years, when that loan is up, you will have paid $80,000 to own the house. So essentially, you're also getting $80,000 over the course of 30 years too. And this is because your tenants are literally paying for you to put that house in your name so that in the future you can go and sell that house. Now, $80,000 divided by 30 years comes out to an average of $2,666. Now, I know it's really not this simple, and there's amortization calculations, but this is just a foundational overview to convince you that real estate investing is a really great opportunity. So we add that $2,666 of principal paydown to our $960 yearly cash flow profit, and we get an average yearly net worth increase of $3,626. And if we take that and divide it by our initial investment of $23,000, it raises our return on investment from 4% to a whopping 15.7%. Now, that's a lot higher than if you were to just go and invest in a stock market, maybe something like an index fund. Now I want to talk about appreciation. The third way that your net worth can increase is through appreciation. Now, average household appreciation for usually anywhere in the US is around 3.5% a year. Now, this is just an average. This means if your house is worth $100,000 this year, next year, on the same day, it should be worth $103,500. $500, which is a 3.5% increase. And then the next year, and so on and so on. So if we use a compound interest calculator and put in $100,000 at 3.5% over 30 years, we get a total of $280,000. Now, we need to subtract our initial $100,000 because remember, we've already calculated that with our down payment and the principal paydown. And that leaves us with $180,000. Again, I know this isn't exact, but it's a foundational concept. $180,000 over the course of 30 years averages $6,000 per year. So you add that $6,000 to a previous $3,626, and we're up to $9,626. So basically, each year, on average, your net worth is going to increase by around $10,000, right? So now we take that around $10,000 and divide it by our initial investment, how much money we actually had out of our own pocket, $23,000, and we get a whopping 41.8% return. It's not cash, it's net worth. This means that our net worth is almost doubling every 2 years. Let's say that you achieve this 41.8% return every year for 10 years. And for every one of those 10 years, you buy a whole new house, using the basic principles of spending around $20,000 on the down payment and around $3,000 on closing costs. Within 10 years, you'll have a net worth of $2.5 million. You'll be a multimillionaire. Now, if we do absolutely nothing after that and stop buying houses, and we just let our initial investments keep growing for another 10 years, at the same rate of 41.8%, we will be up to $81 million of net worth. Now, I know what you're thinking. It's crazy. And honestly, it really is. This is why 90% of every millionaire invest in some sort of real estate. And I know it's not an exact science, and most of this video is just all perfect in theory. Since it's real life, you'll have to evict tenants, sometimes houses catch on fire, bad things happen. You just have to find the right houses with the right numbers and so on. Most real estate investors can get an easy 10% average long-term ROI, and some really do get 41.8% return on certain deals. But if you're new, do not expect 41.8% return. And I did say there were 4 ways you can increase your net worth. The last one is tax benefits. Also, there's one last way you can earn money. Rather, it's actually saving money. Real estate investing, especially in the US, offers some amazing benefits on the tax side. In fact, you can deduct the whole price of a building from your taxes. You can deduct all repairs, you can deduct insurance and homeowner fees, and you don't have to pay any taxes on any expenses that you use to rent out your building, including advertising. Now, I've been researching the tax side for a little bit, and it's pretty complicated to explain in one video, but you should know that the tax benefits of real estate can save you a very large percentage of money every year. Also, I want to let you know that even during the 2008 global financial crisis, which we can all kind of agree was caused by the housing market, and because of that, it caused a lot of house prices to crash, like almost down to 25% of their original value, rent at the same time stayed the same. And in some cases, rent actually increased because there were so many people out there afraid of buying new houses. So the big picture here is that usually you don't have to worry about rent prices dropping. And if they do drop, they don't drop down to 25%. Also, housing is a market that people will always need and will always increase in value. Every year, prices go up because of simple economics. Think about it. Land and houses are scarce, and the demand increases every year because there's always more people. So the price will always go up. So this is just something that I've been researching, and I kind of wanted to share with you.